Following on from the year-end updates launched by us at the close of the financial year 23-24, Insync with BDO India is back with another session on navigating the regulatory landscape, providing key year-end reminders and guidance for private companies in the financial reporting process. We welcome Vishal Divadkar, partner and head audit and assurance, to take us through the same and also discuss some key IFRS amendments that are likely to be implemented in the coming years. Over to you. Thank you.
Thanks, Pallavi, and welcome all to another episode of Insync. As we approach reporting timelines for private company audits and half-year reporting for listed companies, this session would focus on key financial reporting and other regulatory matters. I intend to do a quick reminder and refresher on a few of the Ind AS amendments that became applicable for the March 24 year end. The new audit trail compliance requirement, which obviously created quite a stir, and also highlight some of the big ticket SEBI updates and changes that have been issued during the past few months. I'll finally cover the two new IFRS standards that were issued globally, IFRS 18 and 19. So I'll begin with the Ind AS amendments. While there haven't been wholesale amendments and new standards in the works even globally, specifically for FY 23-24, there haven't been many new developments. However, on 31st March 2023, MC had issued the following key amendments. One relating to material accounting policies. The rationale for introducing amendments to Ind AS 1 was to encourage entities to provide entity-specific accounting policies and not only have generic or standard boilerplate information that just summarize the requirements from the Ind AS or IFRS standards. The expectation is that there will be streamlining and decluttering of the financial statements. The amendments provide that accounting policy information is material if, when considered together with other information included in an entity's financial statements, can reasonably be expected to influence decisions of primary users. It may be noted that an entity's conclusion that accounting policy information is immaterial does not affect the related disclosure requirements set out in the Ind AS itself. For example, an entity may conclude that it has no material accounting policy information to disclose relating to PP&E, for instance, in a services industry. However, if material, the entity must still disclose the information required by Ind AS 16 on property, plant, and equipment as part of their notes. So where does one start? Each policy should be ideally reviewed and could be removed unless it relates to an accounting policy choice available as per the existing Ind AS standards. Example, with respect to inventory valuation under Ind AS 2, carrying amount of subsidiaries either at cost or fair value as per Ind AS 27. Else, policy has changed during the year, or it explains a complex transaction, example, a business combination or a derivative accounting requirement, or it relates to an area of significant judgment or assumption. In these cases, the accounting policy should be disclosed. In all other cases, it should be explored whether an accounting policy is as such material or not. Also, under Ind AS 110, the evaluation of control could involve significant judgment due to factors like de facto control. The shareholder agreements could include clauses which either demonstrate that control exists, example, the right to appoint a majority in the board in spite of having less than 51% ownership, or indicate that control may not exist conversely, example, substantive rights held by the other shareholders. So the accounting policy would be expected to bring out the nuances or the basis principles applied for consolidating the subsidiary and not just reproduce IFRS 10 or Ind AS 10 from the standards. Overall, it is expected that the number of policies should reduce and only those that are really pertinent to the users would be maintained. The other change with respect to Ind AS 8 was accounting estimates. The current version of Ind AS 8 did not provide a definition of accounting estimates. Accounting policies, however, were defined. But the standard defined the concept of a change in accounting estimate. In the amended standard now, the accounting estimates are now defined as monetary amounts in financial statements that are subject to measurement uncertainty. That is, the accounting policy may require such items to be measured at monetary amounts that cannot be observed directly and must instead be estimated. In such cases, an entity develops an accounting estimate to achieve the objective set out by the accounting policy. Accounting estimates typically involve the use of judgments or assumptions, beg your pardon, based on the latest available reliable information. I would not expect the amendments to have a material impact on entities' financial statements. However, the amendments will provide helpful guidance for entities in determining whether changes are to be treated as changes in estimates or changes in policies or errors. The final change or amendment was to Ind AS 12 with respect to deferred tax. Ind AS 12 has been amended to clarify the scope of initial recognition exemption. It is now clarified that the IRE does not apply to the initial recognition of an asset or liability which at the time of the transaction gives rise to equal taxable and deductible temporary differences. Example, many leases and asset retirement obligations. Many entities have applied this approach in the past already, as Ind AS 12 was unclear, but this may result in a change for some entities. To illustrate, consider that an entity has entered into a leasing transaction. Under Ind AS 116, it recognizes a right of use asset and a lease liability at the commencement date of the lease. Under the Income Tax Act, the entity will be eligible for tax deductions only when it makes the lease payments. In such cases, apparently, the following two views were possible. Apply the IRE separately to both the asset and liability. Thus, no deferred tax asset or liability is recognized, and the tax impacts get recognized in the P&L in the period in which they are incurred. Or consider the asset and liability together as part of an integrally linked transaction for deferred tax considerations. The consequence is that no IRE applies and deferred taxes are in fact recognized at the start. Moving on now to the audit trail requirement, which is absolutely a unique concept to India. Globally, no such similar reporting obligations exist. After much debate for over the past 2 years, this has finally been made applicable for all companies from the last financial year. So why has it been so stressful? Let's recap on the requirements. As you're aware, the rules require for each company to use accounting software that record the audit trail to capture the change history, including the who, what, and when of all relevant transactions impacting the books of accounts. So for FY 23-24, every company which used accounting software for maintaining its books of account shall use only such accounting software which has these features of recording audit trail of each and every transaction, creating an edit log of each change made along with the date when such changes were made, and ensuring that the audit trail cannot be disabled. Since it is the management's responsibility for maintaining books of account, they are thereby also responsible for ensuring selection of the appropriate accounting software for ensuring compliance with applicable laws and regulations, including those related to retention of audit logs. The auditor has to report whether the company has used such accounting software which has the feature of recording audit trail, and the same has been operated throughout the year for all transactions recorded in the software. The audit trail feature has not been tampered with, and the audit trail has been preserved by the company as part of the statutory requirements for record retention. The auditors are required to comment on the above matters both in case of reporting on standalone financial statements and also consolidated financial statements. Few of the practical challenges that have been faced. The accounting software typically could be hosted and maintained in India or outside India, or maybe on premise or on a cloud, or it could be subscribed to as a software as a service. In case of accounting software supported by service providers, the company's management and the auditor may consider using independent auditor report of the service organization. So a SOC 2 type 2 or an SAE 3402 report for compliance with the audit trail requirements. Also to note, unlike reporting on internal financial controls, Rule 11G requires that the auditor to report that the feature of recording audit trail facility has operated throughout the year for all transactions recorded in the accounting software. Again, there has been some debate on what constitutes books of account. Believe it or not, any software that maintains records or transactions that fall under the definition of books of account as per section 2 subsection 13 of the act will be considered as accounting software for this purpose. The Companies Act definition is fairly comprehensive and includes records maintained in respect of all sums of money received and expended by a company in respect of its receipts and expenditure, all sales and purchase of goods and services made by the company, the assets and liabilities of the company, and also the cost records per section 148. Various standard softwares do have this feature. In fact, however, certain ERPs had intentionally disabled the audit trail feature as it would slow down the application. The database and storage architecture may have limitations, as we've seen. The revised implementation guide that was issued by the Institute contains certain FAQs which may provide helpful guidance on practical aspects and situations, and it also clarifies the auditor's reporting responsibility in such situations. For instance, what if there are technical glitches at some point of the year? There are certain transactions or periods where transactions have not been recorded in the application. Is materiality relevant? What if the audit approach is a 100% substantive approach? So, from an auditor standpoint, the implementation guide does provide some guidance, but also reinforces the requirements of the law. Hence, it is advisable for companies to seek external help, both from an IT standpoint and also audit standpoint. This slide really just captures a few actions that would be expected of both the company and how auditors are and would respond and test the compliance. Majority of the reports, including for larger companies issued till date, have had a comment or an adverse comment indicating non-compliance. As it is with all new legislation, this reporting area will also evolve. And my view is only time will tell how this is finally embraced by all stakeholders, including, of course, the regulators. Moving on to BRSR, as you might recall, in July 2003 last year, based on the recommendations of the ESG Advisory Committee and pursuant to public consultation, SEBI decided to introduce disclosures and also assurance for the value chain of listed entities as per the BRSR core. The BRSR core is a subset of BRSR consisting of a set of key performance indicators, metrics under the ESG attributes. From 2023-24, the top 1,000 listed entities by market cap shall make these disclosures as per the updated BRSR format as part of their annual report. Further, listed companies shall mandatorily undertake reasonable assurance as per the glide path specified by market cap. The glide path is as follows, as you see on the slide. So for the top 150 listed companies from 23-24, for the next top 250, 24-25, for the top 500, the year 25-26, and then the top 1,000 in the year 26-27. The listed entity shall ensure that there is no conflict of interest with the assurance provider appointed for assuring BRSR code. There are FAQs issued as well with respect to conflict and independence by SEBI. As part of the outreach and the subsequent deliberations by the committee, it appeared that there were a number of hurdles faced by the covered listed companies as specified above in terms of their readiness for reasonable assurance and also for providing disclosures for the value chain um, as key factors considered as the basis for the committee's recommendations. Based on the recommendations again, which were also deliberated by the SEBI ESG Advisory Committee in May 2024, SEBI issued a consultation paper to propose changes to the requirements of BRSR and BRSR code under the LODR regulations. So instead of assurance, replace the word with assessment. The Industry Standards Forum or the ISF will develop these assessment standards. From FY25, it will be the assessment standards and not the assurance standards that will apply. The International Auditing and Assurance Board or the IAASB has proposed the International Standard on Sustainability Assurance 5000 general requirements for sustainability assurance engagements, which outlines the general requirements for sustainability assurance engagements, given the global momentum in this space. In light of this, it is imperative that while formulating the assessment standards in India in collaboration with ISF, SEBI should strive to develop a standard that aligns with the global benchmarks and assurance requirements. This alignment will ensure that external assurance assessment significantly contributes to reinforcing trust and confidence in both financial and non-financial reporting and also align with global benchmarks. This will reflect SEBI's commitment to fostering a robust ecosystem for sustainability reporting that aligns, like I said, with global practices and meets investor demands for high quality and reliable sustainability related information. Similarly, for value chain reporting, which was voluntary for FY24 and 25, the voluntary assessment and assurance from 26 would apply. Value chain partners to include upstream and downstream partners that individually account for 2% or more of the listed entities' purchases or sales by value, or a cumulative threshold of at least 75% of the listed company's purchases or sales by value, in addition to the individual 2% or more threshold. Listed entities would need to disclose the percentage of the total sales and purchases covered by the value chain partners for which ESG disclosures have been provided. Moving on to a few more SEBI amendments that were issued recently. Um, as you recall, as per the existing regulations, only rumors pertaining to material events or information require verification by the listed entity. However, the amended provisions provide that market rumor should be verified if there is a material price movement in the securities of the listed entity. The amendment regulation also provides that the unaffected price should be considered for transactions on which pricing norms are specified by SEBI regulations or the stock exchanges are applicable, provided that the rumor pertaining to such transactions has been confirmed within 24 hours from the trigger of the material price movement. The regulation erstwhile specified that the unaffected price shall be considered by excluding the effect of the price of the equity shares of the listed entity due to the material price movement and confirmation of the rumor. Thirdly, the amendments require promoters, directors, KMPs, senior personnel, management to provide timely responses to the listed entity for verifying the market rumor. The industry standards note of the ISN issued by the ISF outlines standard operating procedures for complying with rumor verification mandate, which listed entities are required to adhere to. Also, there's a framework now for material price movement to ensure adherence to the criteria of significant price movement for market rumor verification in conjunction with SEBI. And finally, a framework for considering the unaffected price given the above mentioned requirements. And this was issued in the circular dated 21st May 2024 that provides detailed framework and guidance for determining such unaffected price by listed entities. A few more recent LODR amendments, market cap is now to be determined basis the average market cap for the 6 months ending 31st December. Earlier, it was 31st March. Introduction of the sunset clause of 3 years for cessation of applicability of market cap based provisions. In case of vacancy of key management personnel, the timeline for filling up such vacancies now extended from 3 to 6 months. Timeline for prior intimation of board meetings now reduced to 2 working days. Earlier varied from 2 to 11. The gap between meetings of the risk management committee increased from 180 to 210 days. And finally, the applicability of the LODR regulations to debt listed entities. The timeline for this now has been further extended to 31st March 2025 from the earlier March 24. Finally, some global IFRS amendments that came into being from this financial year. So the first being IFRS 18, disclosure and presentation in financial statements, which would replace IS1. So this standard represents the completion of a major standard setting project on presentation, and therefore will have significant implications for many companies reporting under IFRS. This new standard will help companies provide information about their financial performance that is useful to the users of financial statements in assessing prospects for future net cash inflows to the company and in assessing management stewardship of the company's economic resources. One of the key features of IFRS 18 is to require companies to classify all items of income and expenses into one of the 5 categories of operating, investing, financing, income taxes, and discontinued operations. Whilst the first 3 categories are new, IFRS 18 provides specific guidance to assist preparers in identifying items to be classified in each of these respective categories, especially for companies with specified main business activities of investing in assets or providing finance to customers. The categories are complemented by the requirement to present totals and subtotals for operating profit or loss before financing and income taxes, and profit or loss. The new standard also provides the aggregation and disaggregation of items such as assets, liabilities, equity, expenses, revenue are based on shared characteristics to provide uniformity. Companies are required to aggregate or disaggregate items to present line items in the primary financial statements to provide useful structured summaries. Furthermore, in the notes to the financial statements, companies are required to aggregate or disaggregate items to provide material information, but in doing so, must not obscure material information. Another important feature of the new standard is management defined performance measures. There's been always a debate on how GAAP and non-GAAP measures should be disclosed and the balance that need to be maintained. An MPM is a subtotal of income and expense, not really listed in the IFRS accounting standards, nor specifically required to be presented or disclosed by an IFRS standard. Companies use MPMs in public communications outside financial statements to communicate to users management's view of an aspect of financial performance of the company as a whole. As MPMs are required disclosures under IFRS 18, they will be subject now to audit. The disclosure requirements will enhance, in my view, the transparency and the communication effectiveness of the company's financial performance. Other new standard introduced this year was IFRS 19, which applies to subsidiaries without public accountability. Basically, when a parent prepares consolidated financial statements that comply with IFRS, its subsidiaries are required to report to the parent using IFRS accounting standards. But for their own financial statements, as a result, the subsidiaries were effectively also producing a set of full-fledged IFRS financial statements, or where they were permitted, were using IFRS for SMEs. However, such subsidiaries may not apply IFRS for SMEs as they are already required to report to their parent entities using the IFRS standards. Now, and as we know, the IFRS standard for SMEs differs significantly from the full IFRS standard. When subsidiaries apply IFRS accounting standards for their own financial statements, they are required to provide disclosures required by the full IFRS, which may be disproportionate to the information needs of their users. This issue was highlighted by stakeholders in their response to IASB's request for views agenda consultation. The stakeholders asked the IASB to permit a subsidiary reporting to a parent applying IFRS accounting standards in its CFS to apply IFRS standards with reduced disclosure requirements in its own financial statements. Considering this feedback, the project has now culminated in the issuance of IFRS 19, which permits eligible subsidiaries to apply reduced disclosure requirements while applying the recognition, measurement, and presentation requirements of IFRS standards. As you'd expect, the subsidiary eligible for this to apply IFRS 19 will not have public accountability, and as an ultimate or intimate parent that produces CFS available for public use that comply with IFRS standards. So with that, we draw close to this episode of Insync. I hope you found this useful and informative. I wish you all the best for the quarter and the half year ensuing, and also for the year end reporting for private companies. So till next time, thank you. Take care.